IAS 1 again. Presentation of financial statement. So far we have covered about the definition, what are the different components of financial statement, general features of financial statement. We have discussed 9 features of financial statement, and right now our topic is statement of financial position. We have seen what are the various items to be included in financial position, and then we discussed what is current asset. We took some examples also on current asset. Now we'll start with current liabilities. What is current liability? Same definition we have studied in accounts classes. A liability is current liability. Now here, when any of these 4 conditions are satisfied, okay, then the liability is a current liability. 1, it is expected to be settled in its normal operating cycle, like your current asset only, expected to be settled in its normal operating cycle. For example, trade payable and other operating payable. What is an operating cycle? Time required to convert raw material, cash into raw material into WIP into finished goods, into debtors, and again into cash. Operating cycle can be 12 months, more than 12 months, or less than 12 months. So if creditors or if the liability is expected to be settled in its normal operating cycle, it will be current, even though it may be more than 12 months, even if the normal operating cycle is more than 12 months. Second, it is held primarily for trading purpose. That your objective is to trade in that item, buy and sell. Here there is no time limit. Example of a liability which is held for trading: financial liabilities, which we are going to learn in financial instrument standards, IFRS 9 or IAS 32. Okay. Example, derivatives. Derivatives are held for trading purpose only, so they can be a current liability. Third definition is the most popular one. It is to be due to be settled within 12 months after the end of the reporting period. Underline after the end of the reporting period, not from the date of the invoice. Now, point number 1 is expected to be settled in its normal operating cycle, and point number 3 is due to be settled within 12 months after the end of the reporting period. Now my question is, which one will you take if there is a conflict between 1 and 3? If the normal operating cycle is suppose 15 months and this is 12 months, so we will take 15 months. If it is normal operating cycle is 9 months, then we'll take 12 months. So we'll take one example when you'll find there is a conflict and how to resolve that conflict. Point number 4, it cannot be unconditionally deferred for at least 12 months after the reporting period. That means the entity does not have the unconditional right to postpone the payment for more than 12 months. If the other party, the counterparty, demands the payment, the entity has no option but to pay it. Suppose you have a loan outstanding and the loan is going to get due in next 12 months. There are 2 possibilities. 1, the entity has the unconditional right to roll over the period of the loan. Unconditional right to roll over the period of the loan. That means they can renew the loan for another, say, 3 years. And who has this unconditional right? Entity. What will be the nature of the liability? It will be, suppose the entity wants to roll over that, non-current. because then you have an unconditional right to defer for more than 12 months. But if the right to decide whether the loan should be rolled over or not is with the bank, entity does not have the right to roll over, then in that case it will be a current liability because you don't have unconditional right. Or suppose you have issued a convertible instrument, okay, where the option to convert is with the counterparty, that is the investor, okay. He may decide to convert, he may decide to opt for cash. If he decides to opt for cash, the entity does not have the unconditional right to defer the payment. Then that portion of the convertible instrument will become current liability. Okay. The standard defines what is current asset and what is current liability. It has not defined what is a non-current asset or a non-current liability. So all other assets and all other liabilities will be classified as non-current. All other assets and other liabilities will be classified as non-current. Now this paragraph is there in the IAS 1. Refinancing of liability. Financial liabilities are classified as current when they are due to be settled within 12 months after the reporting period, even though the original term was for a period longer than 12 months. So first we'll read and interpret this part. Suppose an entity has taken a term loan on 1/4/2019 for 3 years. So what will be its original classification? Non-current. Now we are preparing the financial statement. It will become due on which date? It will become due on 31st March 2022. Now suppose we are preparing the financial statement for year ended 31st March 2021 and this loan is getting due on 31st March 2022 and the entity does not have an unconditional right to defer the payment. What would be the classification of this liability on this date? So it will become current liability now. Now the same loan you will shift from non-current liability and write it under the head current liabilities. So the meaning of this line is financial liabilities are treated as current when they are due to be settled within 12 months after the reporting period, even if the original term was for more than 12 months. So be careful while you present your answer. That portion of long-term liability which is due to be settled within 12 months from the reporting date is current. Next, there is one more clause here, and an agreement to restructure or refinance on a long-term basis is made after the end of the reporting period but before the financial statements are authorized for issue. Okay. This same example will take 31st March 2021 is year ending date. This loan will mature on 31st March 2022. Okay, this is the year ending date. The board of director authorized the financial statement for 31st March 2021, let us say on 30th June 21. Okay, this period is called event occurring after the financial statement date, after the SOFP, event occurring after the reporting date. Now suppose you negotiate with the bank and the bank extends the due date to 31st March 2023. The bank says, okay, we extend the due date of this loan to 31st March 23. the question arises, what would be the presentation of this loan in the balance sheet, in the SOFP? So it will be treated as current only. It will be treated as current only because this agreement to restructure or refinance took place after the end of the reporting period, but before the financial statements are authorized for issue. So this is specific requirement given in the standard. Next is entity. An entity breaches a provision of long-term arrangement. One more important point, an entity breaches a provision of a long-term arrangement. What is the breach? Suppose it has not filed the stock report, not filed the debtors report, and the loan agreement says in case if you don't comply with the loan agreement, then the loan will become repayable on demand. Is it right? If you do not comply with the conditions given in the loan agreement, the loan will become payable on demand. Now there is an entity which breaches the provision of the loan agreement. Okay, and then it goes to the bank, requests the bank that please don't make it a loan payable on demand. So this bank agreed to that. Okay, this is small breach, minor breach, we will ignore it. But when did this negotiation with the bank take place? After the reporting period, but before the financial statements were authorized for issue. The question is, what would be the status of that liability? Current. It will be classified as current liability. Even if the lender agreed after the reporting period and before the authorization of the financial statement for issue not to demand payment as a consequence of the breach. Underline. Is it right? I have done it for you. Why I am emphasizing on this paragraph? In IND AS 1, the same paragraph says, if the lender agreed, then you will follow whatever original classification was there. Suppose it was a non-current, you will follow the non-current classification. So this is one, you can say, major difference between IAS 1 and Indian version IND AS 1. Okay. An entity classifies the liability as current because, now what is the reason given by IAS 1? Entity classifies the liability as current at the end of reporting period. It does at the end of the reporting period when we are preparing the financial statement. On that day, this standard takes the stand. It does not have an unconditional right to defer its settlement for at least 12 months after that date. Whereas IND AS 1 takes another view. IND AS 1 says once the banker has agreed, the lender has agreed, it becomes an adjusting event. Whereas this standard specifically says it is a non-adjusting event. So as on the reporting date, you didn't have an unconditional right to defer the payment. Okay, now we'll solve one question. Number 5. Entity X has taken 10% short-term loan of rupees 10 lakh from a bank which will fall due for payment on 30th June 2019. The entity finalizes accounts every March. The entity has discretion to roll over the loan till 30th June 2019. The entity has a discretion to roll over the loan till 30th June 2019. Should the loan be classified as current liability? You can make a small change in the date. What is the year ending date of this entity? Is year ending date given? No. So we will first assume year end date is 31st March 2019. Then we will make a small correction here for a better understanding. 2020. Okay. Now we'll read the problem again. Our year ending date is 31st March 19. This loan is due for payment on 30th June 19. Okay. Now here the entity has an discretion to roll over the loan till 30th June 2020. That means whenever the loan will become due for payment, they can extend the maturity to 30th June 2020. Who has the discretion here? Entity X Limited. Entity X. So my question is, what would be the classification of this loan on this date? Current or non-current? Now you can call it as a non-current because you have an unconditional right to defer the payment for more than 12 months from the end of the reporting period. But what if the entity did not have discretion? The lender had discretion. Then the answer would be current. So as per IAS 1, the loan is classified as non-current since it enjoys the discretion to roll over the loan for a period of more than 12 months after the reporting period. However, if or when refinancing or rolling over of the obligation is not at the discretion of the entity, the obligation will be classified as current. Okay, solve one more question. X Limited has identified its operating cycle as 12 months, comprising of raw material holding period 4 months, production time means work in progress 1 month, finished goods holding period 3 months, collection period 4 months, gross operating cycle 12 months. It is not same. Let us read further. As on the reporting date, on 31st March 2015, X Limited carried out age analysis of various trade payable as follows. Now tell me, is it same? Yesterday it was a current asset item, spare part. Now today it is a current liability item, trade payable. So therefore, your question is not exactly same and therefore be careful. We are doing the aging analysis of trade payable. We found that we purchased goods on 1/7/14 for 10 lakh. So as on the balance sheet date, it is already 9 months they have completed. Then on 1/2/14 5 lakh. This is for more than 12 months. It has exceeded the operating cycle. It has exceeded the operating cycle period. And on 1/10/14 20 lakh, it is still within the operating cycle of 6 months. So first and third, no doubt, will be treated as current because they are still within the operating cycle period. But what about the second one? The second one, if I apply the first criteria, they are expected to be settled in the normal operating cycle period. It goes into non-current definition. But if I apply the definition expected to be settled within 12 months from the end of the reporting period, it will become current. Question is not clear about when is this likely to be settled. If the management intends to settle it within 12 months, what will be the classification? Current. But if the management does not intend to settle it within 12 months, the classification can become non-current. So normally we will see what is the intention of the management, what are their past track record, what is the agreement with the creditor. Then we will take a final call whether we will treat it as current or non-current. So you will write the age on the balance sheet date 9 months, 14 months, 6 months. 9 and 6 will fall in current liability because they are within the credit operating cycle period. but 14 is beyond operating cycle period. So if written as non-current with an asterisk mark here. However, this trade payable item is subject to another test also. What is the other test? Is it expected to be settled within 12 months after the reporting date? If the answer to this question is yes, then in that case management will classify it as current liability. So you have to write two answers for this 5 lakh. Expected to be settled within 12 months from the end of reporting period, current, and is not expected to settle within end of the 12 months, then non-current. Two examples looked similar, but they were not. They had some differences. Now one more small question. X Limited has unclaimed dividend of rupees 20 lakh on 31st March 2019. Classify unclaimed dividend into current and non-current liabilities. Current liability. Because anytime the shareholder can demand the payment and you cannot defer it for more than 12 months. Is it right? So the shareholder can claim the dividend. Now we'll see in the next paragraph what is a normal operating cycle. This is taught in financial management subject also. Is it right? Which comprise of acquisition of asset for processing to the realization in cash or cash equivalent, okay, can be longer or shorter than a period of 12 months. In some industry it is more than 12 months. Example, liquor industry, wine, champagne, okay, older the wine, better the taste. Some of them store it for 10 years, 15 years, 20 years, 40 years also, and then they sell it for a very high price. In that industry, the normal operating cycle is more than 12 months. Construction industry, okay, more than 12 months. CA industry, many years. If you cannot identify the normal operating cycle, if it is not clear what is your normal operating cycle, business models are complicated. Is it right? Then you can assume it to be 12 months. Then you can assume it to be 12 months. Now we will see one important area in financial statement, SOFP, that is share capital. With respect to share capital, they have given some disclosures that should be given, right? Why share capital? Because we should know from where the money is coming into the company. Nowadays funds come from so many sources. There is a risk involved about the source. So world over, the government is keen on knowing how the company is getting the fund, who is doing the funding, okay, who are your investors. It should not come from doubtful sources. So therefore the disclosure requirement of share capital is getting more and more stringent, okay, because there are so many companies who have been promoted by companies in Bahama Island, Cayman Island, Panama Island. We don't know who are these promoters, who are these people, and therefore this disclosure requirement have become more and more stricter now. So the information relating to share capital can be disclosed either in SOFP, both options are there, or statement of changes in equity, okay, as a part of SOFP or in the notes. So you can give either in your SOFP, SOCIE or in the notes. A description of the nature and purpose of each reserve within equity should be disclosed. Companies may have different types of reserve. So now they have required you to give a description of the nature and purpose of each reserve. For example, we have general reserve, capital reserve, capital redemption reserve, debenture redemption reserve, So you have to give the purpose and the description. What are the disclosure requirement for share capital? One is the number of shares authorized. As per the respective regulation, you can issue up to a certain number of shares. Maximum share which a company can issue is authorized. And then the number of shares actually issued, and out of that what is fully paid and issued but not fully paid. Company need not receive the full amount on their share. They can receive part amount, and they can receive part amount at a later stage also. Then par value per share. If the shares have par value, like for example 10 rupees, 1 rupee, 5 rupees, you have to disclose. And if the shares have no par value, that you need to disclose. If the shares have no par value, they are called stock. They are called stock. Stocks don't have par value. Then a reconciliation of the number of shares outstanding at the beginning and at the end of the period. So you have to write opening number of share, add shares issued, less shares bought back, redeemed, cancelled, and closing balance. So reconciliation statement that is showing the movement in the number of share from the beginning till the end. Then rights, preferences and restriction attached to that class of share. If any class of share has any right, preferences and restriction, then that needs to be disclosed. For example, preference share. Preference share have a preference with respect to dividend and repayment of capital. Equity shares may be of two types: voting right and differential voting right. So voting right share will have a right of one vote, one share, whereas differential voting right will have lower voting power but higher rights to dividend. Okay. So whatever are the restriction, preferences, rights, like restriction can be on transferability, etc. also, you can disclose that. Shares in the entity. Now see the disclosure and understand the impact. Shares in the entity held by itself. What is held by itself? Own shares. Own shares held by an entity. In IFRS, in some countries they allow you to hold your own shares. That is called own shares. You will become an investor in your own share. Is it right? So they are technically called treasury shares, or investment in the entity held by its subsidiary or associates. Shares in the entity held by subsidiary or associate means you have received funding from subsidiary or associate. If you are holding your own shares, it means probably the management may be trading in its own shares also. If they find the price is low, buy. If they find that the price have gone up, sell. So this will give you an insight into the company's management style of working, how the funds are coming into the company. Shares reserved for issue under options and contract for sale of shares. This also you have to disclose. In case if you have issued, say, ESOP, that means in future the number of shares are going to go up, and if the number of shares are going to increase, it will affect the controlling stake or the stake of individual investors. So their stake may get diluted. Let them be aware that this company has so many shares which are reserved for issue under ESOP, or you may enter into contract whereby you may sell share in future. Why you need to disclose? Because this will affect the control. It will dilute the control. It will impact the future EPS. It will impact the future market value of the shares. So therefore the investors might suffer loss, because in future the share prices might fall as more number of shares will be issued. Right? Next is a description of the nature and purpose of each reserve within equity that we have discussed. Below that, an entity without share capital, such as partnership or trust, shall disclose information equivalent to that required by previous paragraph, showing changes during the period in each category of equity interest and the rights, preference and restrictions attaching to each category of equity interest. So if there is any entity which does not have share capital, like for example partnership or trust, they will also try to disclose the information given in the previous paragraph to that extent possible, and showing any change in the category of equity interest and the rights, preference and restrictions. Not very relevant for you, but because this is IFRS, it is much wider in the scope. So next few seconds what we'll do, we'll understand the format. The company or the entity can follow this format. Does the standard give you the format? Standard does not give you the format. Standard only prescribes the minimum line item requirement, minimum requirement. But this is the format they can follow if they are following current non-current approach. So this format is for current non-current approach. We have not drawn the format of liquidity approach. Is it right? But entity may follow liquidity approach also. What you will do as a student, if nothing is given, you follow non-current current asset approach, non-current current liability approach for all the chapters in this syllabus. Same format you can follow for IND AS also. Is it right? So what are the examples? You will start with asset side. First non-current asset. Understand the heading first. You will write format of SOF. In name of the company you will write statement of financial position as at. Okay? You have to identify the company, you have to identify the statement, you have to write the date, you have to write the currency, rupee, and in case of rounding off, you have to write rupees in 1000 or million. So this heading should indicate the title, name of the company, what is the statement, the date, currency, and the rounding off. 5 items. Okay. And then 2 columns, current, previous period. Third, SOFP may be required in certain situations. If there is a change in accounting policy from retrospective effect, restatement of item from retrospective effect, or reclassification adjustment. After that, come to this presentation. This is important. You have to know this non-current asset. Under that, PPE, capital work in progress, investment property, goodwill, other intangible asset under development, biological assets other than bearer plant. All this will discuss in the respective standard. Financial asset. Under financial asset, we will have investment, trade receivable, loans and others to be specified. Deferred tax asset. Other non-current asset. Current asset will have following items. You can always add any more line item which is not printed here if you think disclosure of that is required, like inventory, financial asset. Under financial asset, you have investment, trade receivable, cash and cash equivalent, bank balance. Then you have loans, others. Then current tax assets. Net. Net means net of advance tax or net of provision. Other current asset, total assets. So this completes my asset side. Then current liabilities, but it is not called liability side, it is called equity and liabilities, because there are equity related items also. So you'll first write equity. Under equity, you will write equity, share capital and any other equity like retained earning. And since we are preparing a statement of changes in equity, all the details will be written in that SOCIE. Liabilities. Liabilities you divide into non-current liabilities and current liabilities. Okay, non-current liabilities will be financial liabilities. Under financial liabilities, you will have borrowing, trade payable, other financial liabilities, and then we have provisions, other before that deferred tax liabilities. Already discussed, deferred tax liability and deferred tax asset will always be shown in non-current section, not in current section. Why, we will discuss in the respective standard. Other non-current liabilities. What is the next part? Current liabilities. Financial liabilities, under that borrowing, trade payable, other financial liabilities. And then other current liabilities, provisions, current tax liabilities, net. Net means net of any advance tax. Net of any advance tax. So this was a discussion on SOFP. What is the next more important statement, if not more equally important statement? Statement of profit or loss. Statement of profit or loss and other comprehensive income. So first we'll understand some basic requirement about presentation. Again, you understand, IAS 1 gives you two choices. Either you can present statement of profit and loss or other comprehensive income as a single statement, one statement, in which you will write two sections. Section 1 profit or loss and section 2 other comprehensive income. Or you can prepare two statements. First statement will be statement of profit or loss, and second statement will be statement of profit or loss and other comprehensive income, where the profit after tax of the first statement will be transferred to the next statement and all OCI items will be written. Okay. Now this is a difference between IAS 1 and IND AS 1. IND AS 1 has only given one option. Which option? Single statement. So this also you have to keep in mind, that IND AS 1 only allows one option, single statement. Okay. So this two statement if you are giving, it will be statement, income statement and statement of other comprehensive income. As we discussed in the earlier lecture, you can change the nomenclature slightly but indicating the meaning clearly. You may use a different nomenclature every time. You don't need to write exactly what is written here. This is flexible. You can write income statement if you want. You can write total comprehensive income statement. An entity shall present the following items in addition to profit or loss and other comprehensive income section as allocation of profit or loss and other comprehensive income for the period. Now, in case if you are preparing consolidated financial statement, in case if you are preparing consolidated financial statement where the financials of subsidiaries consolidated with financials of parent, then you have to divide the profit or loss between the non-controlling interest and the owners of the parent. And similarly, the comprehensive income means total of profit or loss and other comprehensive income. You will divide between non-controlling interest, means the minority stakeholders in the subsidiary, they are called non-controlling interest, and owners of the parent. This requirement will be applicable if you are preparing consolidated financial statement. If an entity presents profit or loss in a separate statement, then it shall present A, means this part, profit or loss attributable to NCI and parent, in that statement. So then in that case, the profit or loss distribution will be shown in first statement and this comprehensive income distribution will be shown in the second statement. if you are preparing two statements. Okay. Then IAS 1 has given a long list of the information that you need to present in the profit or loss section or the statement of profit or loss. Okay. So in the profit or loss means first section or the first statement, these are the minimum, you can say, the line item requirement wherever applicable. More than that always you can give. And there are two ways you can give profit or loss information: on the basis of nature of item or on the basis of function of item. I will show you on the next page what is the meaning of nature wise classification or function wise classification. So first is a revenue. You have to give revenue to be the profit or loss section will begin with revenue, presenting separately interest revenue calculated using the effective interest method. If there is an interest, it will be calculated using which method? Effective interest rate. In IFRS 9 you will learn it is basically internal rate of return method. Then insurance revenue as per IFRS 17. Gain and loss arising from derecognition of financial asset measured at amortized cost. This again you will learn in the standard on financial instruments. Insurance service expenses from contract issued within the scope of IFRS 17. Income or expense from reinsurance contract. All this will be covered in the insurance contract IFRS 17. Okay. Finance cost, impairment losses, including reversal of impairment losses or impairment gain determined in accordance with IFRS 9. Insurance finance income or expenses from contract issued within the scope of IFRS 17. Finance income or expenses from insurance contract held, again IFRS 17. Share of profit or loss of associate and joint venture accounted for using the equity method. So where will you show the share in profit or loss of associate and joint venture? Share in profit or loss in associate and joint venture will be shown in section A, profit and loss section. Where will you show the share in the OCI of associate and joint venture? In the OCI section. Share in profit section, and share in OCI in the OCI section. If a financial asset is reclassified out of the amortized cost measurement category so that it is measured at FVTPL, earlier it was amortized cost category, now it is FVTPL. Any gain or loss arising from a difference between the previous amortized cost of the financial asset and its fair value at the reclassification date will be charged to or credited to profit and loss section. Which standard talks about this reclassification? IFRS 9. What is IFRS 9? Financial instrument. Okay. Which is counterpart of IND AS 109. If a financial asset is reclassified out of FVT OCI, there is a category called FVT OCI, so that it is measured at FVTPL, any cumulative gain or loss previously recognized in OCI that is reclassified to profit or loss will come in the section 1, profit or loss section. And then you will also disclose the tax expenses on profit or loss. A single amount for the total of discontinued operations. Which standard deals with discontinued operation? IFRS 5. Non-current asset held for sale and discontinued operation. What is the IND AS version of IFRS 5? 105. As we have discussed, this list is not exhaustive. Okay. Now next is analysis of expenses. This standard permits two ways in which you can analyze the expenses: on the basis of nature of expense or on the basis of function of expense. I am going to give you the two presentation just briefly so that you will have an idea. If I am writing finance cost, employee benefit expense, what is that category? Nature or function? Nature. But if I am writing sales promotion expense, administration expense, personnel expense, distribution expense, what is that category? Function. Now again you tick mark. This is a point of difference between IAS 1 and IND AS 1. In IND AS 1 only one method of analysis is allowed, that is nature. Okay, one method is allowed, nature of expenses. So in all other chapters also this difference will appear again and again. IAS allows both. The Indian version IND AS allows only one. Under the nature of expense method, the line item of expense represents aggregation of expenses according to their nature. For example, purchase of material, cost of transportation, employee benefit, etc. Now there is a small profit and loss section I have prepared. So this will give you a hint that this is nature wise presentation. Revenue as usual, other income, change in inventory of finished goods and WIP, raw material consumables used, employee benefit expense. Now this employee benefit can be for selling and distribution also, administration also. We are not bothered about that. It is the nature. We have made payment to employees. Depreciation and amortization, other expense, total expense, profit before tax. Remaining format will be same under both the classification. Only this part will change. Okay. Now this table gives you the function wise classification of expense. So if you are following the function wise classification of expense, then your presentation would be like this: revenue, cost of sale, gross profit, then other income, distribution cost, administration cost, any other expense, profit before tax. This is given in IAS 1. Okay. Last line below that says extraordinary items not allowed. In IND AS or in IFRS, now the concept of extraordinary item is not there in any standard, neither in the P&L account, nor in the OCI, and nor in the notes also. Okay, so you can just mention there, it is not allowed in any of the sections of the financial statement, either P&L account or OCI or in the notes, not allowed. Now the next part of this total comprehensive income is OCI, other comprehensive income. So basically in OCI we normally write income or expense which are unrealized. Okay, earlier they used to be shown directly in the reserves, statement of changes in equity, but now we are presenting on the face of the total comprehensive income, so that the investors will get an idea that these are also the expense or the income. Okay, so even the unrealized income or expense is being shown below separately, so that you will get an idea these are unrealized. Accordingly you understand the performance and take the judgment. The OCI section shall present line items for the amounts for the period of items of OCI, excluding amount in paragraph B Paragraph B is this one, we'll come to this. Classified by the nature and grouped into those that in accordance with other IFRS. So you will basically divide the OCI into two sections. Which two sections? Those items which will not be reclassified subsequently to profit or loss. That means it will remain in OCI, and from OCI it will get transferred to any other reserve, but it will not be again transferred to profit or loss. And second type of item is called which will be reclassified subsequently to profit or loss when specific conditions are met. So this we will discuss in different chapters. Okay, like for example, foreign exchange gain or loss belongs to second category. Once it is realized, it is transferred to profit and loss. Whereas revaluation surplus belongs to first category, that it is not subsequently transferred to profit or loss. So when you read all the standards, in many standards it will come OCI, then it will also be mentioned whether it will be reclassified to profit and loss or not. Point number B, the share of OCI of associate and joint venture. Already discussed with you. When we are preparing the consolidated financial statement, and if we have associate and joint venture, our share in their income is included in the OCI section. Our share in their P&L account will be added in our profit and loss section, and our share in their OCI will be added in our OCI section. So we have standard on associates and joint venture. We are going to see there. Keep this in mind for presentation requirement. Separated into share of the item that in accordance with other IFRS. This also you will divide into two parts, because in their books also it will be in two parts. So same thing you put it here, will be reclassified subsequently to P&L account, or which will not be reclassified subsequently to P&L account. But keep in mind what the IFRS suggests. According to the respective IFRS, you will do the presentation. Now, in your notes, I have written examples of, this list is not exhaustive. Right now, you may not understand also, because this is just the first standard. Unless you read this specific standard, you will not be able to appreciate what is written here. But for the time being, examples of items that will not be reclassified to profit and loss. This can be a question in the exam like this. Following item will not be subsequently reclassified to profit and loss. They will give you four options. One of them will be wrong. Choose the wrong one. And then you have to know this. Is it right? So some examples are printed. Remeasurement of defined benefit plan, which was earlier known as actuarial gains or losses. Which standard deals with this remeasurement of defined benefit plan? IAS 19, employee benefits. Then for liabilities designated at fair value through profit or loss, FVTPL, change in fair value. What is this instrument? FVTPL. Change in fair value attributable to change in liabilities credit risk. Change in the fair value due to change in credit risk. Change in fair value due to change in credit risk. When fair value of borrowing decreases due to decrease in rating, such gain should be recognized in OCI. This we'll discuss in IFRS 9, and that time you will understand better. Once it goes into OCI, it will not be recycled to profit or loss. And the third one, change in revaluation surplus, IAS 16. This you know little bit. If a property, plant, equipment is revalued upward, the gain is credited to an account called revaluation reserve. But first it will be shown in OCI. And when that asset is sold, discarded, the balance lying in this account is transferred to another reserve, whichever reserve the standard will say, IAS 16. Okay, but it will not be transferred later to profit and loss, profit or loss. Next is examples of item that will be subsequently reclassified to P&L account as per the requirement of respective standards. Okay, so I have given you 3 examples here. Whenever we are reading the standard, you have to keep a mark. This item will go to OCI, and then you have to also mark whether it is going to be reclassified into P&L account or not. So this care you have to take, because that will be a question, possible question in the exam. Write 5 examples of item that will not be reclassified to profit and loss, or will be reclassified to profit and loss, or out of 4 items, which is the odd one out. Right? So point number 1, gain or loss arising from translating the financial statement of a foreign operation. I have written the standard number also for easy reference, so that when you will go to that standard, you will remember, yes, this was mentioned in IAS 1 also. So gain or loss on translating the financial statement of a foreign operation. Gain and losses from equity instrument, financial assets measured at fair value through OCI. Entity can decide to designate equity instrument as FVT OCI, and if conditions are met, financial asset as FVT OCI. This is covered in IFRS 9. All financial instrument related discussion will be covered in IFRS 9. Hedging transaction. Effective portion of gain in cash flow hedge, IFRS 9. Change in fair value of time value of option contract when only intrinsic value is designated as hedging instrument, IFRS 9. Change in value of forward element when only change in value of spot element is designated as hedging instrument, IFRS 9. So many of these items that you see here will be covered in probably the most complicated standard, IFRS 9. Some knowledge of finance is required to understand IFRS 9. Like for example, time value of an option, intrinsic value of an option, hedging instrument, forward contract, spot contract. Then you will be able to understand IFRS 9. Now next is the presentation of tax effect of OCI item. OCI item also will have tax effect. Is it right? How to present? So again there are few choices given here. Accordingly you will follow. Each component of OCI, these are the component 1, 2, 3, whatever, according to your company. Each component of OCI is required to be disclosed either net of tax effect, either net of tax effect. Net of tax effect means, suppose this amount is 100 rupees, tax effect is 30, you can disclose 70, net of tax effect. Or gross basis. Gross basis means you will write 100, and tax will be presented separately for all OCI item. Tax will be presented separately for all OCI item. Gross basis with a single amount showing the aggregate amount of income tax relating to those component. So if you see the SOFP of companies, they follow this approach, gross approach. They write gross item one by one, and the tax effect of all the gross item together they will write as a single line item. The standard provides an option to disclose the tax effect of each component of OCI either in the statement of OCI itself, that is what you can do here, or you can disclose separately in the notes. So tax effect will be either presented in OCI or will be disclosed in the notes. OCI item can be shown gross or can be shown net. Now we will go through one format. Does IAS 1 give you this format? No. This format is not given by IAS 1. This is based on what they have recommended, that these are the items that should be shown. So this is simplified format. According to your question, you can change it slightly. This format is based on the first one, single statement format. And then I have also given below that two statement format. Same thing, I have just bifurcated into two parts. Okay. Secondly, this format is based on nature of expense method. See on the screen here, in your note also I have written nature of expense method, right? Not on the basis of function of expense. So this is quite detailed one, but still it is quite simple, I will say, because many more items could have been incorporated in this format, which has not been done. So what is the normal way of presentation? Single statement. This is single statement format. In one statement, you have profit or loss also and OCI also. So you will write like this: statement of profit and loss and other comprehensive income. Then for the year ended, rupees in, you will write the currency. Then you will write the unit of measurement here. Rupees, thousand, million. Nature of expense method, single statement format. This you don't have to write in the exam. This is just for today's understanding. And of course, we'll write the name of the company at the top. Current year figure, previous year figure. And you can write note number, because here we are only writing the total of the respective income or expense. The detailed working will be shown in the notes. Okay, the disaggregated figure, the bifurcation will be shown in the notes. So let us read. First you will write revenue from operation, other income, total revenue, expense. Under that we have cost of material consumed, purchase of stock in trade, changes in inventory of finished goods, stock in trade and WIP, employee benefit expense, finance cost, depreciation and amortization expense, other expense. So all other items you can put in this other expense also. Total expense. Difference between total revenue and total expense is profit or loss before any exceptional item and tax. And then you can disclose any exceptional item if you want. Profit or loss before tax, tax expense, current tax, deferred tax. This will give you profit or loss for the period from continuing operation. And then you will show profit or loss from discontinued operation separately. Which standard? Discontinued operation? One, IFRS 5. IFRS 5. Then tax expense of discontinued operation and profit or loss from discontinued operation after tax. So this means what you have done, you have told your investor, this is what I am earning from continued operation and this is what I am earning from discontinued operation, so that he will know that whatever income or expense is mentioned here, profit or loss is mentioned here, will not be there in the subsequent year. So don't consider that in your evaluation of future performance. Then total of these two will be called total profit or loss for the period. This is the part 1, profit or loss section, part 1. And then part 2, in case if you want to present any item separately, then you can present. Standard will be, there is no standard, but this is the format given in the IND AS format issued by the government. So maybe that IFRS or IND AS, IAS 10, IAS 8, sorry, accounting policies. or you can ignore it also. And there's no specific standard dealing with exceptional item. In case if you want to highlight some item, as we discussed, you can always add a line item here. Okay, like loss on sale of machinery, if you want to present separately, you can put it over here, but otherwise you can remove it. It is a flexible format. Okay, if you write it, nothing wrong with that. If you don't write it also, it's okay. So exceptional item you can remove. Depending upon the nature of the item, if you want to present it as a separate item, you can put it. So now we'll come to the second part, that is other comprehensive income. So from here your other comprehensive income start. So here you will divide into two parts. Items that will not be reclassified to profit or loss, and income tax relating to items that will not be reclassified to profit or loss, items that will be reclassified to profit and loss, and income tax relating to items that will be reclassified to profit or loss. This will give you total comprehensive income for the period. You will add 13 and 14. 13 is profit or loss, 14 is OCI. And then as we have discussed, if you are preparing the consolidated financial statement, you will divide this profit, point number 13, profit for the period, into two parts: owner of the parent and minority interest or non-controlling interest, right? Non-controlling interest. Non-controlling interest. We are used to calling minority interest, but the IFRS and IND AS now don't use the word minority interest. Then total comprehensive income, this portion, again divide into owner of the parent and non-controlling interest, and then you could disclose earning per share. Earning per share for continuing operation divided into basic and diluted, discontinued operation divided into basic and diluted, and for both continuing and discontinued operation divided into basic and diluted. So this we will cover discussion in a separate full standard called earning per share. Do you know number? No, we don't remember. Anyway, presentation of comprehensive income in two statement format now. Two statement format means the first format will be called statement of profit or loss for the period. I'm not reading now. It is same up to profit or loss for the period. Up to para 13 it is same. Then after para 13, you will have to divide this profit or loss into two parts: owner of the parent and write non-controlling interest. Owner of the parent and non-controlling interest. And then based on this profit or loss, you have to prepare EPS calculation for continuing operation, for discontinued operation, and for continuing and discontinued operation. Whatever profit you have got here, this you will transfer to the next format now, which we'll call statement of profit and loss and other comprehensive income for the period. Start from profit or loss for the period. This figure you will take from the point number 13 of the previous statement, and then all those other comprehensive income item into two parts, which are not going to be reclassified to profit and loss and which are going to be reclassified to profit or loss, right? And then you will get the total comprehensive income. In this format you will divide the total comprehensive income into two parts: owner of the parent and non-controlling interest. Okay. So in the P&L account, the profit will be a portion between the two. In this format, the total comprehensive income will be a portion between the two. So how much we have covered now? SOFP, profit and loss, OCI. Now we'll come to reclassification adjustments. OCI is of two types. Those which are subsequently reclassified to profit and loss, and those which are not subsequently reclassified to profit and loss. Which will be classified into profit and loss and which will not be reclassified is governed by respective IFRS. Okay. So some IFRS specify the timing and amount of income and expense recognized in OCI to be reclassified into profit or loss. Like IAS 21 allows you to reclassify foreign exchange gain or loss relating to foreign operation in the profit and loss. These adjustments are termed as reclassification adjustment. Okay, these adjustments are called reclassification adjustment. Example also I have written the same one. The portion of the OCI attributable to foreign operation is recognized in profit or loss at the time of disposal of foreign operation. Which standard? IAS 21. Such reclassification requires adjustment to retained earning, that is profit or loss, of the earliest comparative period presented. Because this is those items which requires you to prepare 3 set of financial statement, reclassification adjustment. So earliest period profit and loss will be adjusted for this, so that the statement will become comparable. Reclassification adjusted effected during the period needs to be disclosed. Any reclassification adjustment done during the period will be disclosed separately. Now we'll come to statement of changes in equity. In short, we will call it SOCIE. Write in bracket SOCIE. It's basically, what is this statement? Here we disclose equity plus all types of reserve. And again, what is this item? It is basically the movement from opening to closing. Opening, any addition, any deduction, and closing balance. So this is like in nutshell what is going to be this SOCIE. For each reserve you open a separate column. During the year you see what has been the change in that reserve. You have to do plus and minus and reach the closing balance, and total will be transferred to statement of financial position. So nothing great about it. An entity shall present a SOCIE as a part of SOFP showing total comprehensive income for the period, showing separately a breakup of amount attributable to owner, that is shareholders of the parent, and NCI, that is shareholder of subsidiary other than parent. So if you are preparing CFS, you will have one more column for NCI also. Okay, you will have one more column for NCI, and whatever is the share of NCI in the profit or loss or other comprehensive income, you will also allocate it to NCI. Effect of retrospective application or restatement recognized during the period will be disclosed here. We'll see the format, you will understand better. We have seen in your beginning of this standard, if there is any retrospective application of accounting policy, retrospective restatement of an item, then the third balance sheet is or third SOFP is prepared and the effect will be shown in the SOCIE. For each component of equity, a reconciliation, this is reconciliation from opening to closing, whatever movements have taken place, reconciliation between carrying amount at the beginning and at the end of the period in respect of profit or loss, that is basic income statement or OCI. If there is a transaction with owner, example, issue of share, buyback of share, dividend, and change in ownership interest in subsidiary, that do not result in loss of control. We'll discuss in one standard called IFRS 10. Change in ownership interest in subsidiary that do not result in loss of control. For the timing, suppose you're holding 70% share, you sold 10% share, you are still holding 60% share, so you still have control, but then NCI share will go up, your share will come down, so some adjustment will have to do. So that is your point number this. Then items such as capital reserve, changes that arise from transaction with owners, example, issue of share, buyback of share, etc., and certain transaction with subsidiaries that do not affect control over subsidiary and required to be disclosed for as equity transactions. So these are the requirements. Now the standard requires that the changes in equity should be presented in the form of a statement. Long back when you were in the 12th standard, we used to write one heading equity capital and one heading reserve and surplus. Now instead of that, this entire thing will appear in the form of a statement called SOCIE. Okay. And in case of consolidated financial statement, you have to show a breakup of the amount attributable to owner and NCI. In respect of profit or loss, that is when you are going to prepare the SOCI, owner's share, write in owner's column, NCI share, write in NCI column. You'll get this figure from those two statements, and their share in OCI, transaction with owners. Now you see one format of OCI, SOCIE. You will write name of the company, SOCI for the period ended, rupees in whatever is the unit of currency. See, there are two ways you can do it. One is you can show equity share capital separately and reserve separately, or you can add one column for equity also, equity share capital in the main one only. Equity share capital, you will show balance at the beginning, change during the year, and balance at the end, and then other equity. In fact, some companies, what they do, instead of part A and part B, there is one column here for equity share capital. So while solving the problem, we will do the same because we have less time. So in the same format, equity share capital, and these are the columns for respective headings. Now I have written 14 columns, but you don't need to write. According to the question, according to the number of reserves appearing in the problem, you will draw the columns. What will be the basic structure of this SOCI? First, you will write balance at the beginning, add or less, change in accounting policy or prior period item. So if there is a change in accounting policy or prior period item from retrospective effect, because of that the opening balance will undergo a change, because you have to bring forward the effect of that change in accounting policy or any prior period error. You will get the restated balance at the beginning of the reporting period, and then you add total comprehensive income for the year. This you will get from the statement of profit or loss and other comprehensive income. Whatever is the share, write in the respective column. NCI share, write in the NCI column. If any dividend is paid, write in the respective column from where it is paid. If there is any transfer to retained earning, any other change, and balance at the end of the reporting period. So it is simply like opening balance, any addition, deduction, and closing balance. What are the possible columns you can draw there? in that column number 1 to 14, you can write, for example, share application money pending allotment, equity component of compound financial instrument, capital reserve, securities premium, other reserve, retained earning, debt instrument through OCI, equity instrument through OCI, effective portion of cash flow hedge, revaluation surplus, exchange difference on translating the financial statement of a foreign operation, other items of OCI specifying the nature, money received against share warrant, total. You can add NCI column also. So 2 more columns, NCI and then grand total also. Right. Now we'll come to the fourth statement. Which was the first one? SOFP. Second, SOPL. Third one, SOCIE. Now statement of cash flow. We don't call it cash flow statement. We will call it statement of cash flow. Now this chapter is not going to discuss this much. We have a separate standard on this, IAS 7. Okay, a cash flow statement is prepared as per IAS 7. Make a small correction. IAS 7. Okay, cash flow statement is the only statement which is not prepared on accrual basis. It is prepared on actual receipt and actual payment basis. What is the purpose of preparing cash flow statement? It helps the users of financial statement to understand how the entity is able to generate the cash and how the entity is able to utilize the cash. Okay. So what you show in profit or loss statement is based on accrual. What you show in cash flow statement or statement of cash flow is based on cash income. A company may be making lot of profit in the statement of profit or loss, but what is the point in earning profit if it can't be realized in cash? So nowadays, world over, the investors are interested in the statement of cash flow. Profit figure can be manipulated. Cash flow figure cannot be. And they want to compare, if you are showing profit for the period, what is your cash flow from operating activity? Are they matching or not? At least to some extent. Of course, they will take into consideration non-cash item, etc. But if there is a large variation, it means you are not able to convert your profits into cash. Then this statement also gives you information about investing activities, financing activities, where you are investing your cash and how are you financing your activities. How are you raising finance? Okay. Now we'll come to the last few paragraphs. Notes. So one of the important features of IFRS is notes. Notes are very detailed under IFRS because they contain lot of disclosures. What has not been explained in SOFP, SOPL, statement of change in equity or cash flow statement, they will be explained in the notes. So what are included in the notes? Notes will include among others. So it's an inclusive statement. For example, it will include measurement basis. How various assets, liabilities, income or expenses were measured. The basis of measurement could be, for some cases, historical cost, for some cases, current cost, for some items like inventory, net realizable value, for financial instruments, it may be fair value, or for sometimes for property, plant, equipment, it may be recoverable amount. So whatever is the basis of measurement for different assets, liability, income, expense, you have to mention. In notes, you have to mention the accounting policies adopted. disclose information required by IFRS which are not specifically disclosed elsewhere. Information not presented elsewhere but are required for understanding of the financial statement can be disclosed in the note. And then you have to give a statement of unreserved compliance with IFRS. Unless you comply with all the requirement of all the IFRS, you cannot say that our financial statement are IFRS compliant. Okay. In the notes, you will also give information about management judgment. Yesterday we talked that now, because of so much of disclosure requirement, the information gap has reduced between the management and the stakeholder. Okay, so the disclosure will also include description of the areas in which management has exercised the judgment or has adopted the estimations. So what management have been thinking, even to that extent, the disclosure is required. Next is sources of estimation uncertainty. A specific disclosure requirement relates to assumptions that the management makes about the future. So this is a specific disclosure requirement in case if the management has made assumption about the future. Because a lot of figures may have been based on future figures, future estimation, like recoverable amount in the case of property, plant, equipment, and other major sources of uncertainties that carry the risk of resulting in a material adjustment to the carrying amount of assets and liabilities in the subsequent period. So this disclosure you have to give about future assumption, estimation, which might change, and as a result of this, the carrying amount of assets and liabilities can undergo a significant adjustment, material adjustment. Example, estimation of the effect of technological obsolescence on inventory carried. Due to changes in technology, inventory might become obsolete. To what extent they might become obsolete is based on the estimation of the management. That you need to disclose. Then I have written one general note. Notes should be presented in a systematic manner, and cross-reference should be made to each item in the profit and loss, cash flow, statement of financial position. It's written balance sheet here, you can just make it SOFP. What is the purpose of cross-referencing? The purpose of cross-referencing is that if you are reading the SOFP and you want to know what are the details of inventory, you can just go to the respective note number and read the details. This you know very well because you have been preparing the financial statements in your offices. Cross-referencing helps you to quickly refer the respective notes. And then one more disclosure you have to give in the notes is how the entity manages its capital. Risk is involved. In business, risk is involved as to how you manage your capital. Too much of, say, use of debt may increase the financial risk. As you may be aware, some companies have gone into bankruptcy because of excessive use of debt or mismanagement of their capital. Is it right? So therefore, some information about the way the entity manages its capital, how it raises the capital, debt equity ratios, etc., that you have to disclose. What is the objective? So that you can understand the impact of the capital structure on the financial risk of the company. These information include information that would facilitate users of financial statement to evaluate the entity's objective policies and processes for managing the capital. You are actually, it's like sitting in the management cabin now, because what they discuss there to some extent is also made available to the investor. How do they manage their capital, etc. is known. The requirement is supplemented by clarification to the effect that an entity may provide a description of what it manages as capital, whether it is subject to any externally imposed capital requirement. For example, as you may be aware or you may not be aware, banks are now required to follow Basel requirement for capital adequacy. That means they must maintain a certain amount of capital compared to their asset, risk-weighted asset. And if their capital is less, then they will have to either increase the capital by issuing more equity or such capital, or reduce their exposure to the risk asset. That you need to explain, and the manner in which it is meeting the objective for managing the capital. So this is a note that they will have to give about how they manage their capital. No disclosure is required in situations where an entity has established its own internal norms for managing capital. This disclosure will be given only if it is required by some external agency like the RBI in India. But in case if there is an internal norm for managing the capital, disclosure is not required if internal norms are not met. Too much of private information also cannot be shared here. What are the other disclosures? First one, tick mark, dividend related. Dividend proposed or declared after the reporting period, but before financial statements are authorized for issue, and cumulative preference dividend that are not recognized. This will be disclosed in the notes. Dividend proposed or declared after the reporting period will not be shown in the financial statement like SOCIE. Okay, but they will only be disclosed in the notes that the company has proposed the dividend or declared the dividend. Accounting will be done, that is, the liability will be created only after it is properly authorized by the respective bodies like AGM. Before that you can't create a liability. Okay, disclosure that these are not recognized shall be made in the notes, but at least you can only inform the investor that the company is proposing 5 rupees per share as dividend. And now next is general information that you have to disclose about the company: the entity's domicile, legal form, country of incorporation, address of registered office, nature of entity's operation, principal activities, name of the parent, and you have to also give the name of ultimate parent. How the money has been flowing into the company, you need to explain, because capital can come from various channels. It can come from illegal channels also, risky channels also. So therefore, nowadays world over, the regulating agency want to track the flow of capital into the company, because this is very risky. So this completes the standard IAS 1. Now we'll make a quick revision of how IAS 1 is different from IND AS 1. Okay, so this is also a part of your syllabus, comparison of IAS and IND AS. There are not too many differences, so this list is only this much. These are the differences. We have identified them while reading the statement also. One by one, come again. This statement uses the term fair presentation, IAS 1, instead of using true and fair view presentation, which is just a change in the nomenclature, but otherwise it makes no difference. Fair presentation or true and fair. Second is, IFRS allows a 52-week period for annual financial statement. 52-week period, whereas IND AS does not talk about 52-week period, it talks about only 1 year. But again, I think both are not significantly different. Then balance sheet is referred to as statement of financial position in IAS 1. Statement of profit and loss is referred to as statement of comprehensive income in IAS 1. statement of comprehensive income can be presented either as a single statement or as two statements. Income statement and statement of other comprehensive income. One more difference is analysis of expenses in IAS 1 can be either based on the nature of expense or can be based on function of expense, whereas under IND AS 1 it can be only based on nature of expense. And one major difference is the treatment of the last point, a long-term loan arrangement where a breach of material provision has resulted in loan being due should be treated as current as per IFRS, even if the lender has agreed for restructuring before the approval of the financial statement for issue. But in IND AS, it can be classified as current or non-current depending upon that particular situation. Is it right? This standard is over.